Hello guys, welcome to the page of Commerce Shiksha. Today we'll discuss the difference between capital and revenue transactions. Let's start with what is capital expenditure. Capital expenditure is something that brings into existence an asset. It has a long-term impact and goes in the balance sheet. It is non-recurring and non-routine in nature, and it increases the current productivity or earning capacity of the business. Now let's discuss some examples of capital expenditure. As you can see, building, car, furniture, computer, commercial vehicles, software, factory. These are some of the examples of capital expenditure. Now let's discuss the meaning and features of revenue expenditures. Revenue expenditures are those the benefit of which lasts us less than a year. These are general expenditures and they go to the P&L account. These are recurring and routine in nature, that means they are repetitive, unlike capital expenditures, and these help us to maintain productivity and the current earning capacity, the current efficiency, as opposite to the capital expenditures, which helps us to increase the current capacity. So whatever expense that we incur which helps us to maintain our regular business are revenue expenditure. Let's move to the examples of revenue expenditure. Some of the examples of revenue expenditure are labor, repairs, professional fees, fuel, gas, fire insurance, cleaning and maintenance, and electricity. Now let's discuss the receipt side of capital and revenue transactions. We'll start with capital receipts. Capital receipt means any inflow of money which is of course non-routine and non-recurring in nature. For example, if you are receiving a loan, if you are having shares, if you are issuing shares, if you are selling a house or any asset, that is capital receipt. Now let's start with the revenue receipts. Revenue receipts are basically our incomes that we show in the profit and loss account on the credit side. These are our earnings that we earn from selling our goods or providing services. There are some non-operating receipts also, for example, rental income. All these things come under revenue receipts. Now let's move to the last topic of this video, deferred revenue expenditure. Deferred means delayed. Okay, so there are certain expenditures which are normally of revenue nature, revenue expenditures, but due to certain special reasons or special characteristics, they fall under deferred revenue expenditure. For example, certain advertisement costs which are huge in quantum basically, and the companies incur them when they are, say, launching a new product or entering a completely new market where they are not recognized by the common people, by the common consumers. Okay, so what will happen? Let's take an example. Suppose every year in the last 5 years, for example, the company has spent, say, rupees 5 crores each in each financial year. But now this year, because they are launching a new product, they have spent almost 100 crore rupees on the same category. If they put entirely this sum in their profit and loss account, that will show a very distorted picture of their profits, which will also not be true. Plus, they spend this amount of money because they think that this will also help them generate income or revenue in the coming years and not just in the current year. That's why such expenditure by a company which is huge in quantum and doesn't happen regularly, but primarily it is a general expenditure, is called deferred revenue expenditure. How do we treat this? We generally see that for how many years the deferred revenue expenditure will reap us benefit, and we write off the amount in such number of years. With this, we come to the end of this video. I would love to have your feedback and comments. If you have any advice, if you have any feedback, please leave it down below in the comment section. If you liked our video and you want more people to see it, please share, like and subscribe. and we'll see you soon again. Thank you.